Bitcoin and crypto are not the same thing. Now, this might sound obvious to some of you, but the distinction is crucial. And most people, including many sophisticated investors, completely miss it. It's like grouping together gold with every other metal on the periodic table and treating them all the same, but they're just not. The United States even has a strategic Bitcoin reserve, not a strategic crypto reserve, and there's a very good reason for that. Today, I'm going to break down the fundamental differences between Bitcoin and everything else in the crypto space. And by the end of this video, you'll understand why Bitcoin stands alone, not just as the first cryptocurrency, but as something fundamentally different from everything that came after it. This isn't about tribalism or maximalism. It's about understanding the profound distinction that most investors, journalists, and even regulators consistently fail to grasp. Let's start with the origins because they matter tremendously. Bitcoin emerged from the 2008 financial crisis as a direct response to the failures of the global banking system. Its anonymous creator, Satoshi Nakamoto, designed it specifically as a peer-to-peer electronic cash system that would function without trusted third parties like banks. Crucially, Satoshi disappeared around 2011, never revealing their identity, never profiting from Premines, and never exercising influence over Bitcoin's development thereafter. Bitcoin truly launched with zero premine, zero venture capital, zero ICO, and zero central authority. In stark contrast, nearly every other crypto project has identifiable founders or foundations with massive token allocations. Ethereum, for example, had a pre-sale that distributed about 72 million ETH, with founders and early investors receiving significant portions. Solana raised millions from venture capital firms like Andreessen Horowitz. Ripple's founders pre-mined 100 billion XRP, and this origin difference creates fundamentally different incentive structures. When founders and venture capitalists hold massive token allocations, their interests often diverge from the users. They can dump tokens on retail investors, change protocol rules, or prioritize short-term profits over long-term stability. And Bitcoin's immaculate conception means that no entity has this kind of influence or financial interest in the protocol. Decentralization isn't binary, meaning you're decentralized or not. It exists on a spectrum, and on this spectrum, Bitcoin truly stands alone. Bitcoin currently has over 17,000 publicly accessible full nodes distributed across the globe. Anyone can run a node with modest hardware and verify the entire blockchain independently, with no permission required. Compare this with Ethereum, with around 4,000 nodes, many requiring substantial hardware resources, or Solana with barely 2,000 validators, all requiring significant hardware and stake. But node count is just the beginning. True decentralization extends into development, in which Bitcoin has dozens of independent implementation teams and hundreds of contributors with no central authority. Almost every other crypto project has a foundation or a company directing its development. With consensus changes, even modifying Bitcoin's core rules requires near universal consensus among its users, miners, and developers. Most other projects can change the rules through foundation decisions or small validator groups. With attack resistance, Bitcoin's hash rate makes it prohibitively expensive to attack, requiring billions in hardware and energy costs in order to do so. Many altcoins could be attacked for millions or less. Here's a concrete example of this difference. When the Bitcoin community couldn't agree on block size changes in 2017, that debate lasted years and eventually resulted in a minority fork called Bitcoin Cash, while Bitcoin itself remained completely unchanged. No central authority could force the change, and if you compare this to Ethereum's transition to proof of stake, or Solana's numerous shutdowns and restarts, these projects have central teams that can effectively mandate protocol changes or pause the networks during problems. And true decentralization matters because it's the foundation of Bitcoin's key value proposition, a form of money that cannot be controlled, censored, or manipulated by any entity, whether corporate or governmental. Bitcoin's scarcity is absolute and unchangeable. There will only ever be 21 million Bitcoin. This isn't a promise or a roadmap. It's mathematically guaranteed by the protocol itself and is verified by thousands of independent nodes and enforced by miners around the world. Nearly every other cryptocurrency has a more complex, flexible, or simply inflationary monetary policy. Ethereum, for example, abandoned its issuance cap entirely and now has an unpredictable supply model. Many proof-of-stake coins issue new tokens based on staking participation, and most DeFi tokens have complex issuance schedules with team allocations, treasury funds, and liquidity mining. Let me show you what this means practically. Since 2009, Bitcoin's issuance schedule has never changed and was set in motion from the very beginning. Every 4 years, the block reward gets cut in half from 50 to 25 to 12.5 to 6.25 Bitcoins per block. And in the most recent halving, it brought that 10-minute issuance down to 3.125 Bitcoin every block. Interestingly, the amount of Bitcoin released per block correlates with the percentage of the supply that will be released in that 4-year period. In the current 4-year period of 3.125 Bitcoin per block, 3.125% of the total 21 million coins will come into existence. This is just another example of beautiful and symmetrical design that you'll find in many places when you study the Bitcoin network. This predictability and certainty are unmatched in the crypto space. When you buy Bitcoin, you know with absolute certainty what percentage of the total supply you own, now and forever. Now, look at Ethereum's history by contrast. It began with one issuance model, changed it multiple times, and then completely abandoned the idea of a fixed supply. Team leaders like Vitalik Buterin can influence monetary policy changes for better or worse. And this difference is crucial. Bitcoin's absolute scarcity makes it uniquely suited as a store of value and monetary asset, while other cryptocurrencies, with their flexible supply models, simply cannot fulfill this role in the same way. Bitcoin has a crystal clear use case: digital money that can't be manipulated, censored, or controlled. Everything about its design serves this singular purpose. This focus and clarity stands in stark contrast to the broader crypto space, where projects attempt to be everything to everyone. Smart contract platforms promising to be world computers, DeFi protocols trying to recreate the entire financial system, NFT platforms building digital art marketplaces, and GameFi projects merging gaming with speculative finance. There's nothing inherently wrong with these experiments because, of course, innovation is going to require trying many different things over time. But here's the key difference. Bitcoin isn't trying to compete with Visa, Amazon Web Services, the New York Stock Exchange, Christie's Auction House, or Xbox Game Pass all at once. Bitcoin does one thing: monetary sovereignty, and focuses exclusively on doing it exceptionally well. Its development prioritizes security, reliability, and long-term stability over adding new features or chasing the latest trend. This focus matters tremendously. The monetary use case requires extreme reliability, security, and stability, attributes that often conflict with the rapid iteration and feature expansion seen in other crypto projects and the leading edge of the tech world. Bitcoin makes deliberate trade-offs to prioritize what matters most for a global, decentralized monetary system. Other projects make different trade-offs for different purposes. What makes Bitcoin a unique, long-term store of value isn't just the technology. It's the combination of technology with specific properties that have defined money throughout human history. The best monies historically share specific attributes, from durability, a resistance to physical degradation, portability, being easy to transport, divisibility, the ability to be split into smaller units, fungibility, each unit being interchangeable, verifiability, an ease of being authenticated, and scarcity, or a limited supply. Gold dominated for thousands of years because it excelled at most of these properties, particularly scarcity and durability. And Bitcoin improves on gold in nearly every single category while maintaining true scarcity. Other cryptocurrencies may have compelling use cases, and some may even succeed wildly in their respective domains, but they fundamentally lack the monetary properties and origin story that position Bitcoin as a digital gold, the largest monetary store of value asset in the world. Bitcoin's adoption curve follows the classic pattern of money: first as a collectible, then as a store of value, then as a medium of exchange, and eventually as a unit of account. We're currently in the store of value phase, with medium of exchange use cases growing in specific contexts. The significant difference is that Bitcoin's value proposition improves with time. Every year, Bitcoin survives and strengthens its case for being supreme in durability. Every halving enhances its scarcity. Every new user improves its network effects. And this is why Bitcoin mining operations are becoming strategic national assets. It's why major institutions are building Bitcoin treasuries. And it's why President Trump established a strategic Bitcoin reserve, not a strategic crypto reserve. Now, let me be clear. I'm not saying other cryptocurrencies have no value or no potential. Many projects are doing interesting work in their respective domains. What I am saying is that Bitcoin stands fundamentally apart, not just as the first cryptocurrency, but as something categorically different from everything else in this space. And it is worth focusing on above learning about others because of how profound of a shift it represents. Something that can be lost in the noise of a space that has no shortage of hype. Bitcoin is digital monetary infrastructure, an entirely new asset class with properties that make it uniquely suited to store and transfer value across time and space without centralized control. Understanding this distinction is crucial for anyone looking to build wealth in the digital age, and it's why we focus on professional Bitcoin mining, rather than chasing the latest crypto trends or even crypto mining. Depending on market conditions, equipment costs, and electricity rates, we help clients mine Bitcoin at a significant discount, often 30 to 90% below the current market price. And when you view the space through this lens, with Bitcoin as digital monetary infrastructure and everything else as just various technology ventures, your investment approach becomes much clearer and more focused. So if you want to learn more about professional Bitcoin mining and how it helps you acquire Bitcoin at a significant discount, follow us at Abundant Minds or visit abundantminds.com to schedule a consultation. Thanks for watching. I'll see you in the next video.